Morning,
Given
Axel.
what we're seeing in the bond markets and the rising yields, is it time to rethink the equity strategy now?
Yeah, I mean, it's interesting. I mean, in the US, if you look, I mean, last night, as you mentioned, the S&P pumped through, quite significantly through to all-time highs again, and yet the bond yield actually remained pretty still. I guess if you assume that the cost of capital in an economy should broadly equal its trend nominal growth rate, then what does a yield of 2.5% say about the future nominal growth prospects for the US economy? For us, we're not that worried. We think that actually, there's some structural factors at play in the bond market. The falling supply of treasuries probably has something to do with it, and you're probably going to need a more meaningful positive surprise from the US economy to shape bond investors out of that 30-year decline in yields.
So what is going to do it for you? When will you guys start questioning the rationale behind this massive rally
in equity markets?
Yeah.
Do you know what? I mean, in a way, this kind of slower pace of economic growth that we've seen probably likely means that you could have another couple more years. For us, there doesn't yet seem to be the signs of sort of economic arrogance that you'd expect before a sort of crash. So far, if you look, there's some signs of overvaluation, mainly in the bond market, but it doesn't look to be a bubble there necessarily. There's also some worrying signs in terms of return of cov-like lending and stuff like that. But again, there's not yet the signs that would really worry us that there's a need for a recession just yet. So we could see a couple more years of sort of gently rising equity markets from here.
I mentioned Nestle, Valeant, Alstom, GE, Siemens in there as well. We've got M&A talk on one side, we've got IPO talk on the other. IPO fatigue, some say, is creeping in now. To what extent is all of this driving these gains, and how dangerous is it to rely on that?
Yeah, it's an interesting question because, I mean, at its very simplest, M&A activity represents the retirement, the net retirement of equity in exchange for cash. So, in theory, M&A should be good for equity market valuations. But for us, what we really want to see is corporate spending on investment. We want to see that infrastructure spend, that long overdue, pick up in a more meaningful capex spend, particularly in the US, but there's also plenty of room for it in Europe. We think we're starting to see signs of it, in terms of sort of the business confidence data and capex intentions, and I think that's really what we want to see. M&A is good for equity market valuations, and it's not necessarily as value destructive as some might have us believe. But really, what we want to see is some of that sort of long-term infrastructure spend, and that will give us a bit more confidence about the future trajectory of the global economy.